Have you ever thought about the real cost of financing a brand new car? Often, when we dream about buying a brand new car, we tend to focus on the gleaming paintwork, the luxurious interior, and the cutting-edge technology. We get so caught up in the allure of owning a new vehicle that we overlook the actual costs tied to financing it. Let's break it down. When you finance a car, the initial costs include a down payment. This is typically a chunk of the car's total price you have to pay up front. Then, there are the monthly payments. These payments are a combination of the car loan principal and the interest you pay on that loan. And let's not forget about the interest rates. Depending on your credit score, interest rates can vary significantly. And over the lifespan of your loan, the accumulated interest can be a substantial amount. But the costs don't stop there. When you finance a new car, you're required to carry full coverage insurance, which is more expensive than the minimum liability insurance required for used cars. These insurance premiums can add a hefty sum to your monthly expenses. Now let's add these costs up. The down payment, the monthly payments, the interest rates, and the insurance premiums. When you consider all these factors, the cost of financing a new car can be quite an eye-opener. Often these costs can add up to a figure that far exceeds the car's actual value. So, the next time you're tempted by that shiny new car, remember the real cost goes far beyond the sticker price. The allure of a new car can be intoxicating, but it's essential to be mindful of your financial health. After all, a car is a depreciating asset, and it's worth considering if the financial commitment of a new car truly adds up. In the next scene, we'll delve into the depreciation dilemma, another crucial aspect that plays a significant role in the real cost of owning a brand new car. Did you know a new car loses about 20% of its value the moment you drive it off the lot? Now that's a staggering fact to digest. This is what we call depreciation, and it's a financial concept that can have a major impact on your wealth. Think of depreciation as the silent thief that sneaks into your garage each night, shaving off a chunk of your car's value while you sleep. It's an inevitable process that affects all cars, but hits new ones the hardest. Let's imagine you've just bought a brand new car for $50,000. The moment you take it for its first spin, it's already worth $40,000. By the end of the first year, it might only be worth $42,500. That's a loss of $7,500 in value in just 1 year. But what if you finance that car? Well, you're not just losing money on depreciation. You're also paying interest on a loan that's tied to an asset that's losing value. It's like pouring water into a sieve. The faster your car depreciates, the more you end up owing than what the car is actually worth. This situation is often referred to as being upside down on a loan. And it's a predicament you want to avoid. Why? Because if you need to sell the car, or if it's totaled in an accident, you could end up having to pay the difference between what your insurance covers and what you still owe on the loan. Depreciation doesn't discriminate. It affects luxury sedans and modest hatchbacks alike. But remember, it's most brutal in the first few years of a car's life. So the next time you're tempted by that new car smell, consider the silent thief that comes with it. Depreciation is a silent wealth killer that can turn your dream car into a financial nightmare. And that's something worth thinking about before you sign on that dotted line. But wait, there's more. Have you considered the hidden costs of financing a new car? When we talk about financing a new car, the first thing that comes to mind is the sticker price and the interest on the loan. However, the real cost of owning a new car goes far beyond these obvious expenses. Let's start with loan origination fees. These are costs that your lender charges you for processing your new loan. They might be folded into your monthly payments or charged up front, but either way they add to the overall cost of your vehicle. These fees can range anywhere from 0.5% to 1% of the total loan amount. Next, we have insurance costs. In general, newer vehicles are more expensive to insure. Why? Because they are worth more and thus cost more to replace if they're damaged or stolen. Plus, if you're financing a car, lenders require you to have full coverage insurance, which is pricier than basic liability coverage. Then there's the maintenance and repair costs for newer vehicles. Sure, a new car might not need repairs right away, but it will need regular maintenance. And guess what? Newer cars often have more complex systems and parts which can be more expensive to service and replace. So, while you might not be visiting the mechanic as often, when you do, it could cost you a pretty penny. Finally, don't forget about taxes and registration fees. When you purchase a new car, you'll have to pay sales tax, which can be quite hefty depending on where you live. Plus, registration fees for new cars are typically higher. All these factors combined can make financing a new car a lot more expensive than it initially appears. And these aren't one-time costs. You'll be dealing with higher insurance premiums, maintenance costs, and registration fees for as long as you own the car. When you add up all these hidden costs, financing a new car starts to look like a very expensive proposition. So what's the alternative? How about paying cash for your next car? The thought might seem daunting, especially with the allure of seemingly affordable monthly payments. But let's dig a little deeper. When you pay cash for a car, you're eliminating the need for financing. This means you're not just avoiding paying interest on your loan, you're also sidestepping the potential for any hidden fees that could come with financing. Think of it this way. Every dollar you don't spend on interest or fees is a dollar that stays in your pocket. But the benefits don't stop there. When you walk into a dealership with cash in hand, you're stepping onto the lot with a significant amount of negotiating power. You become a sure sale, a guaranteed transaction, and dealerships are often willing to wheel and deal to ensure that cash sale goes through. This could mean a lower price on the car, or perhaps extra features thrown in at no additional cost. Now you might be thinking, I want a reliable car, and only new cars are reliable. But that's a misconception. There are plenty of used cars out there that are just as reliable as their brand new counterparts. And when you're paying cash, you have the flexibility to shop around until you find that perfect car that combines reliability with affordability. Let's look at an example. Say you're eyeing a car that costs $25,000. If you finance it at a 4% interest rate over 5 years, you'll end up paying nearly $3,000 in interest alone. On the other hand, if you save up and pay cash, you avoid that interest entirely. That's $3,000 that stays in your bank account instead of going to the lender. To sum it up, there's real power in paying cash for a car. It's not just about the money you save on interest and fees. It's about the freedom that comes with owning your car outright, the negotiating power you wield at the dealership, and the opportunity to find a reliable used car that fits your needs and your budget. Paying cash for a car is a financially savvy move that can save you thousands of dollars. So, is financing a new car ever a good idea? Now that's the million-dollar question, isn't it? We've traversed through the maze of new car financing, exposing its hidden traps and pitfalls. From the real cost of financing a new car to the depreciation dilemma, the hidden costs of financing, and the power of paying cash, we've shed some light on the murkier aspects of this common financial decision. Let's revisit some of the key points. Financing a brand new car often comes with a hefty price tag, one that extends far beyond the sticker price. The moment you drive your shiny new vehicle off the lot, it starts to depreciate. This loss in value, coupled with high interest rates and hidden costs, can turn your dream car into a financial nightmare. Then there's the hidden costs of financing. From the interest on your loan to insurance premiums, maintenance costs, and unexpected repairs, these additional expenses can quickly add up, making your new car purchase significantly more expensive than you initially thought. And let's not forget the power of paying cash. By saving up and paying for your car in full, you can avoid the financial pitfalls of financing, including interest charges and the risk of being upside down on your loan. Now, there might be instances where financing a new car could make sense. For instance, if you find yourself in a situation where you need a car immediately and don't have the cash on hand, or if you're offered a 0% financing deal. But bear in mind, these are exceptions, not the rule. The bottom line, financing a new car is generally a bad financial decision. It's a wealth killer, a fast track to financial stress. Instead, consider buying a used car or saving up to pay cash. Remember, your car is a tool, not a status symbol. Choose wisely, and your wallet will thank you. After all, your financial health is far more important than the make or model of your car.